Hi, and welcome to Random Rogers Big Picture for the week of January 27th. Just a couple of things, a couple of bear market factoids I thought I would throw out at you. I don't know if you can hear that. There's a dogfight going on in the background. When the market opened, I had planned on Friday, the market's up. I was going to talk about what I had been previously describing as a feel-good rally. And then, as Friday wore on, it turned more into one of these types of days. So what's next? Either this or this. I think that's the first time I've ever used props. Anywho, so a couple of things. One thing that I talked about with regard to an indication or an indicator of a bear market is something called the 2% rule, which is something I picked up in my time at Fisher. And that kind of kicked in. Basically, the 2% rule is if you average a 2% decline down 3 months in a row, so slow rolling over, which how many times have I written that, that is indicative of a bear market. So on October 9th is the closing high of 1565 in the S&P 500. On January 9th, we closed at 1409. And if you do the math and divide by 3, you get an average of 52 S&P points a month, which works out to 3.3% per month, 3 months in a row. Those aren't big numbers. It's pretty close to the 2% average per month. So I'm going to say that that is a tipping point into, or yet one thing that is also indicating bear market amongst all of the other things that I've been talking about for ages. Obviously, when I first in mid-December, I made a comment. I put up that one S&P chart where it run into resistance, and I kind of noted that I thought that was the start. So I guess this piece of information, for me, anyway, for my thinking, confirms it, and that it's either right or it's wrong. But that's what I think. Another thing I was reminded of, I was talking to a friend of mine, I believe on Thursday, and he reminded me of something called, and I touched on this in a post, sort of, but a rule about bear markets is not about predicting bear markets. It's about once you're in it, maybe what you can expect. And I'll spit this out and chew on it a little bit, and you can draw your own conclusion, as is the case with any information I pass along to you. Draw your own conclusion. Do your own work. But the rule is called the 2/3, 1/3 rule. Basically, what it says is that in the first third of the bear market, time-wise, you get 2/3 of the ultimate bear market decline. So we've seen some fast action over the last, well, really, this month has been really fast action. The last 2.5 months of the year, I would not describe as fast action, consistent with what I just said about it averaging 3.3% down through January 9th. But in terms of magnitude, so at our worst we were down 20 at 13, we at 1338. So we're down, we're not down that much. We're down 220 points, which off the top maybe is 14%. Is that right? 227 points. So 14 or 15%, whatever, give or take. But that, and I made a point in a blog post about, if us being about halfway there, percent-wise, but not time-wise. So kind of tying into this 2/3, 1/3. That kind of implies that we may have, another chunk of down, a meaningful chunk coming up shortly, like over the next couple of months, I'm saying, maybe. And then from there, if we go from about 15 down to maybe, down 20 or 21 or 22 from the peak, something like that, and then just drift a little lower before doing anything else. But I want to reiterate something that I talked about before the bear market started, as it was starting, and still as recently as this week, I'm pretty sure I mentioned it. The manner in which this bear market started was like most of them, if not all of them. There was an excess of some sort. that was going to be different. The market started rolling over slowly. People were slow to recognize it. And then all of a sudden, it caught people by surprise. So I went on and on and on for ages because of the fact that it has started in such a typical manner leads me to conclude that it's going to be a normal bear market, which is down 25 to 30%, and I don't think it's going to be especially long. The coming back up, that may not be as robust as usual. I don't know that there's great visibility for me yet. A lot of people are very worried about certain bad things being worse than before, and that maybe it does mean bad things. I don't know. Right now, I don't need to know. The focus, because there is still more down to come, is protection of assets and just kind of the beginning. And I mentioned this in a blog post about starting to assemble some names that I might buy when this is over without knowing when it will be over. That is a short list that will evolve. It's not something I'm going to share on the blog, but it makes sense to think about when this cycle ends. Leadership is going to come from the same old places it always comes from early cycles: semiconductors, copper stocks, if there are any left, and so maybe buying a copper commodity is better. I don't know. And discretionary will provide some leadership. It won't be the first thing that comes out of the gate, but there will be leadership in some of the earlier cycle things, and that's just how it works. The size of the move in those things providing leadership, we may end up being disappointed in that. And if so, we need to think about some other things. There will be some other countries that come off the bottom better than us. Maybe the ones that don't actually go into economic recession, and there will be plenty that don't, but whose stock prices go down in some magnitude in sympathy with ours. We'll just have to see. But a lot of this is very typical, no matter what you may be thinking. At least it's certainly playing out that way. That's about it. Have a great weekend.